So we're going to continue discussing the financing decision of the company. So let's ask this basic question. Based on our financing choices, how far can earnings before interest and taxes fall before we get into trouble and not be able to pay our operating cash flows? So if a ratio, these coverage ratios, if it falls below 1, that's an indicator that we might not be able to pay. So again, the question is, how far can it drop? The bigger the percentage it can drop, the less risk the company can, will experience. So let's continue on down our line here and talk about how we can do this. So let's take TIE, times interest earned. It's EBIT divided by interest expense. So if this falls below 1, that means we have an issue. It says that we don't have enough operating profit to pay the financing costs. So to find the percentage it can fall, ultimately we take TIE minus 1 and divide it by TIE. You can do the exact same thing with the times burden covered. So let's look at these two ratios. TIE is 23.4. 23.4 minus 1, 22.4. Divide that by 23.4 says that this company, Yamaha, EBIT can drop by 96% before they would have an issue with debt. So they are very safe. If you look at the times burden covered, it's at 1.9, that could drop 47%. So again, it's a very, for Yamaha, we could say that they are very safe when it comes to their debt burden. If we look at Hasbro and just look at the differences, what I like to think here is that this just illustrates a little bit more about financial leverage, right? So here is, if they just use stock to purchase this asset, whatever they have, here's their times interest earned, their coverage ratios. Now here's how far they could fall. So times common covered, right? They could drop 35% before that would be an issue. If they were all bonds, you can see that all of the numbers are lower. So again, what does this mean? It just is an indicator that the more you borrow, hopefully this isn't too shocking, the more you borrow, the riskier the company is and the greater the chance that you might have an issue. So how about debt to assets and TIE? How do they relate? What does this show us? So again, if you look at this table, and I'm not really sure what they're trying to tell us with this table, but you can see over time it appears that companies have been borrowing more. So in 2016, we've divided these industries into, or this set of companies into different industries. And here we have the numbers. Here's times interest earning, and here's their debt to total assets. And I'm just using my general observation skills, but don't look at the 2 on the bottom. If you look at the others, right, and this is where I'm having issues with some of this author's discussions. These numbers aren't that dramatically different. And if debt is lower, for instance here, information technology has the lowest debt to equity ratio, and of course they have the highest TIE ratio, which we would expect. 11.1, again, not dramatically different. Again, look at healthcare's 8.9, 30.29, and it's 11.1 versus 30.7. So they have what? They have higher debt and they have a higher TIE ratio. What does that mean? I think what it means is that there are a lot of things that go into this decision. The companies that have more debt may also have higher earnings before interest and taxes. If they have higher profitability, they have higher TIE ratios. If you look down below here, look at the variables. We're looking at TIE, debt to assets, and return on invested capital. TIE, as we find riskier and risky companies you find that their TIE ratio goes down. That makes sense. You also find that their debt level goes up, but their actual return on invested capital also goes down. So, I mean, they asked the question, where do you think Hasbro would be? I mean, I don't know where they would be, but I would think they would be somewhere here in the middle, right? If we would go back and find out what their TIE ratio is, maybe we could put that in a column here. But we don't have that number right with us, so we don't know what to call that information, right? So let's continue our discussion, right? So we have two kinds of financing schemes, and we want to investigate reported income and return on E. So we want to look at some pro forma statements. Let's look at a company under boom and a company under bust. Let's see what pro forma statements look like for these companies. And really, I just want to concentrate on the bottom here, right? If you look at return on equity, in a bust situation, stock has a higher rate of return than bonds. Why? Well, it makes sense because bonds have interest and bonds do not. If you look at the boom situation, you find out that bonds have a much higher rate of return than stocks. Why is that? Well, it's because stocks have less money invested on this higher income, so the leverage pushes the rate of return up. So again, if you look at the differences, right, it is a pretty wide distribution, if you will, between the outcomes that are possible. 2 to 21, again, if you just use a very stock kind of ratio, it's about 19% difference between whether you were boom or bust in returns. But if you have bonds, the difference is almost 38%, 37.6%. So the range is much higher. Again, that is a great illustration of financial leverage. One of the things that's at work here is something referred to as an interest tax shield. Right? So if T is tax and I is interest, that product, the tax rate of the corporation times its interest payment, that's what we refer to as the tax savings. And quite frankly, I think this is what drives many companies to want to borrow rather than issue stocks. It's certainly one of the more important variables that they would address. So let's look at this company, Aetna. They want to issue $750 million in bonds. Their tax rate's 40%. So what does that mean as far as the tax shield? Well, it's a 3.5% bond. So if you take 3.5% times 750 million, that tells you the interest. Now multiply that by the tax rate. And what you'll find is that the actual annual tax shield is $10.5 million. So by borrowing $750, after they pay interest, right, they get $10.5 million back because of tax savings. Another one of the pieces of analysis that we can look at, they refer to this as crossover analysis. So what we want to do is investigate the variation between EBIT and return on equity. And again, we want to try to find some specific points in this graph. So the dashed line here represents stock financing. The solid line represents bond financing. So first, let's recognize this crossover point. At this level of bond and at earnings before interest and taxes, it doesn't matter whether you use bonds or stocks to finance. The difference in ROE is the same. However, if EBIT is less than that, stock financing creates more profitability than bond financing. Above that, though, bond financing wins. So if there's any chance at all that you think you would have EBIT greater than this $280 million, you should be or have or use bond financing. If they expect $1,000 in EBIT, the difference in ROE is substantial. 30% versus roughly, it looks like around 17 or 18%, right? So they say here it's 76% higher return on equity with bonds than with stock. And again, I think this follows the logic, right? That if you borrow more, there is increases in value to the company. So what level of debt financing is best? Modigliani and Miller did some research and they talked about an irrelevance model. And essentially what this says, in the absence of taxes and other costs, firms' debt levels do not impact value. It's the cash flow that's generated that creates value, not how you financed to get that cash flow. So the debt equity split only determines how the value is apportioned between the holders of debt and holders of equity. And I think in the end, this does make a little bit of sense in a world without taxes. However, we just talked about the tax shield, which implies there is benefit to borrowing. So we need to explore that maybe in some later videos. Look forward to seeing you soon.